Great. Okay. Welcome everyone to tonight's presentation. We'll go ahead and get started. My name is John Mantia. I'm co-founder and director of finance here at Parco. I have my colleagues Quinn and Danny on the line tonight. They'll be helping answer any questions that you have in the Q&A section. We've had I see a lot of familiar faces and a lot of new faces on the presentation tonight. For those of you who are new, welcome. And for those of you who have seen some of these presentations before and our webinars before, welcome back. A little bit of background about us before we get started. We are Parco, which stands for Pension to Americans Retirement Company, and we do retirement and financial planning for anybody with a pension. Our goal as a firm is to save our clients time by figuring out all the things and focusing on the things that affect our federal retiree and client and employee client base. So be it helping people with wealth management, insurance, tax and accounting, even people navigating the home refi process, home sale process, relocating in retirement. We offer and have solutions for all those things, trust and wills too. And we work with people of all stages in their careers, be it those who have just started out, just beginning their career in federal service, those in the middle of their federal service and wanting to make sure that they've tightened up everything before they retire, or those who are nearing the end of their careers and wanting to prepare for a retirement, which may be now imminent and coming down the pike. Our goal is that while not everybody uses us for all the services that we have, while no one uses us for everything that we have, we want every client that we work with to use us for something. And we've been featured in a lot of various publications over the past year and a half. Especially with the pandemic starting, from places like Wall Street Journal, USA Today, US News and World Reports, and different publications, and we're always expanding to new publications. So starting about the intent of these webinars and the goal, a couple of ground rules. We're going to move relatively quickly. Our goal is to keep this presentation to about 20 to 30 minutes. If you do have questions throughout the presentation, ask them within the Zoom question window. We'll be able to answer them there during the presentation or after. We do keep all those answers that we receive private to protect the privacy and confidentiality of all webinar attendees. Also, as usual, you'll receive a survey link after tonight's webinar asking for your feedback, both good and bad. If you think there's something we did great, please let us know. If you think there's something we could improve, we'd love to know that too. But also, if there's a topic that you'd like us to cover that we haven't, suggest it. We're open to feedback and we want to make these webinars valuable for you all. Even tonight's webinar came because we had a lot of clients asking us about the changes that had happened to the G Fund earlier this month. And I think that's a great place to segue into our conversation tonight, which is going to talk about the G Fund's frozen interest rate and what it means for federal employees, retirees, and anybody participating in the TSP in general and in the G Fund in particular. Now, because we're going to be talking about investments tonight, there's a couple of disclaimers I want to make sure that we focus on. Past performance is, of course, not indicative of future results. And throughout tonight's presentation, we're not making any claims about future market projections or anything like that. And all of the analysis that we'll be talking about tonight is based on historical data that we've experienced and that we've seen. So tonight we're going to go through 5 major agenda items. First, we're going to talk about where we are and how we got here. So what's happening with the G Fund and why is right now, why does it matter so much? Then we'll talk about some of the basic mechanics of the G Fund, what it is, how it works. Then we'll talk about how the G Fund's interest works, how that payment is made, how the interest is credited to that account. Then we'll talk about what the G Fund's interest rate means for investors, particularly those looking for conservative allocations as federal employees or retirees. And then we'll wrap up talking about the investment triangle and talk about different trade-offs of different investment types that we help our clients through every single day here at Parco. So let's start by talking about how we got here. So what happened? Well, in the beginning of August, Treasury Secretary Yellen announced that G Fund interest payments would be suspended as part of the extraordinary measures that the Treasury needs to take due to Congress not raising the debt ceiling. The moratorium on the debt ceiling expired, and because of all the federal spending that had happened, especially in response to the pandemic, the government's debt is higher than what is allowed by Congress. And so as a response to this, the Treasury has to take measures to conserve cash. And one of the first methods and one of the first measures that they have as part of the process that they can use is to suspend the interest payments that are made to the G fund. So we'll talk about some of the mechanics in a bit, but it's important to understand that the way the G fund works is that the Treasury pays the G fund an interest rate. Actual cash goes into that account. And so by suspending these payments, that G fund interest payment has been suspended. For easy reference, there's about $270 billion in the TSP G fund. And so if we assume, let's say, a 1% annual interest rate for easy math, that means there's a $2.7 billion annual interest payment due, which means that the monthly interest payment that needs to be paid is almost, is over $200 million. So that's how much, at least, that the government is saving by not making this payment every month. That's an important context. So, but you might ask yourself, okay, well, there's this debt ceiling thing I'm hearing about. Well, what is that? Well, the debt ceiling is a limit set by Congress that says how much the United States can be indebted. Basically, how much it's an easy way to describe it is what is the credit card limit of the United States. And when Congress doesn't raise that limit, it means that the Treasury can't spend the money that's been allocated and can't allocate the funds to the various agencies to spend to affect that, to make that happen. So depending on what can happen, if the debt ceiling crisis and as the debt limit doesn't get raised, is that it can lead to government shutdowns. As federal employees, and some of you may be federal retirees, have experienced during federal shutdowns, the government can furlough a lot of people while they're trying to, again, conserve cash to raise that debt limit so they can pay you guys. So this is something that's particularly become a lot more common over the past several years. And we're going to walk through the timeline here in just a minute. Now, a question that also might get asked is, well, what happens if the debt ceiling isn't raised? Well, to fund government operations and to fund the government, that there's different measures that the Treasury can take. Right now, they've suspended interest payments, but the government even has the option to borrow from the G fund. They have that option to actually borrow funds from the G fund to use to fund the government. And as a federal employee, a federal retiree, or the family of one, you guys are unique in having to shoulder that burden. There's no other 401k, there's no other employer-sponsored retirement plan or IRA that the government can borrow from to fund its operations. If you work for Apple or IBM or any of these big companies or Amazon, their employees don't have to shoulder the financial risk of that firm. They're not asked to do that. Whereas federal employees, that's something that you can be exposed to. Now, an important thing to note is that the missed interest payments of the G fund have to be repaid once the debt ceiling is raised. And if the government borrowed from the G fund, they'd have to pay those funds back too. So there is that law that says, and there's that dictates that the government has to pay that money back. But I know it makes a lot of people uncomfortable that the government has the ability to do so. And what's been happening over the past, especially it's hastened in the past decade, is that these fiscal cliffs or these debt limits have been increasing. These types of situations have happened a lot. We actually pulled this information right from a treasury.gov source, which spoke about how many times the government has suspended interest payments to the G fund. So it happened only a couple times in the 90s, but since the year 2002, it's happened very frequently. In 2002, 2003, 2004, and there was a break in 2006. And then from basically 2011 to now, it's happened almost every year. It's been more common to happen since 2011 than it has been for it to not happen. So, and given all the spending that's happened with coronavirus, with changes in administration, with different political priorities, there's no reason to think that this won't continue into the future unless the debt ceiling is raised by a heck of a lot. So to avoid these in the future. And something to keep in mind is that these fiscal limits, these fiscal cliffs, they're very politicized. And as federal employees, you oftentimes have to, and federal retirees, you guys have to face this and the consequences of that politicization more than any other group of people in the United States, because your jobs are working for the government, and you have you can be furloughed because of the implications of this debt limit, much less having your interest payments suspended in your 401k on your G fund. So with some of those basics out of the way, now let's talk about, or with some of those debt ceiling basics out of the way, let's talk about some G fund basics. So the G fund is a unique fund within the TSP. It stands for the Government Securities Investment Fund, and it's the only TSP fund that's not linked to the market. It's also the largest, or at least it was at the end of 2020. It's the largest of the TSP's funds, but it's not linked to the market. It's not exposed to market risk at all. And it's the oldest of the TSP's funds. It was started back when TSP was started in April of 1987. And it's the automatic allocation for plan participants who don't choose funds to invest in. So if you never elect a allocation within the TSP, your default is going to be the G fund. We've run into many clients before who didn't know they had a TSP at all and never contributed. And when we look into their account, 30 years after they start, they actually have a fair bit of money in the TSP, but it's all in the G fund. So while it didn't gain a whole lot, they still had money going in there because of the automatic agency contribution. Now, important to note is who is invested in the G fund. So nearly all TSP investors have some portion of their assets in the G fund. If you're in the L funds in particular, some portion, even if it's small, of your assets are in that G fund. And then what's interesting as well is that nearly half of TSP participants have nearly 100% of their assets in the G fund. This does, when you think about it, make some intuitive sense, because so many people who are participating in the TSP are retired. And in retirement, people tend to want to invest more conservatively. And the G fund is the most conservative of the TSP's investment fund options. So that makes sense intuitively when you consider how many federal retirees there are, that a large portion of people would have all of their assets in the G fund. But a question that we often get asked is, okay, like it's nice to know those basics of the G fund, but how does it work? How do I get paid? Well, it's unique because it does not track an index. It actually tracks the weighted average yield of approximately 153 Treasury securities on the last day of the previous month. So what does that mean in English? Well, what that means is that the Treasury will look at the yield of all the Treasury securities that are in issue, and it's usually about 150. So they'll look at the 30-year or 30-day, 60-day, 90-day, 1 year. They're going to look at all those different Treasury securities, and they're going to say, okay, what is the average interest rate of all these securities? And then whenever they figure out what that average interest rate is, whatever that number comes to be, that average interest rate is what you get paid in the G fund. So it's that blended interest rate. Now, important to note is that Treasury yields, interest rates, have been declining since I was born, since before I was born. Since the 1980s, Treasury yields have continued to go down. Back in the 1980s, I'm sure many of you remember, your mortgage rate was probably in the teens, and you could get, high double digits or you could get double digits on a bank account. Well, because of different changes to particularly monetary policy over the past several decades, interest rates in the United States in particular, and in general, though, around the world, have gone down. And they've continued to push down. Well, because the G fund tracks interest rates, the interest that's paid on the G fund has declined as well. Back in the 1980s, when the TSP was first introduced and the G fund along with it, interest rates were higher in that fund. There was almost 10% or almost 9%, excuse me. But now they've declined a lot, such that in 2020, the average return on the G fund was 0.97%. Year to date, for 2021, the G fund's only up or has only received interest credit of 0.77%. So 77% of 1%, less than 1%. And so what's interesting to note is, what would have happened to a G fund investment at the beginning of 2020? How much would that have grown to today? So if we model it out, if we graph it out, $1,000 invested 19 months ago would have grown to, at the end of July, $1,016. So you would have made $16 on a $1,000 investment within the G fund over that 19-month period throughout the pandemic. So interesting transition there. As of August, the annual effective interest rate on the G fund is 1.25%. So 1.25%, just over 1% is what you're earning right now on the G fund. Now, when the government does pay, when the Treasury does pay that interest, they don't pay you 1.25% per month. They take this number, they take this 1.25% number, they convert it into a monthly number, a monthly compounded number, and that's what they pay you in the TSP. So when we do that conversion, another interesting fun transition is we take that 1.250% and we do the conversion math where we basically add 1 to that 1.250%, raise it to the 1.25, and subtract out 1 to get the effective interest credit per month. And for August, that translates to a 0.103%. You might also hear this quoted as 10 basis points or 10.3 basis points, if you ever hear people say or speak like that. So that means that you're getting just over 0.1% interest credited to your G fund when the government does pay you currently. Yields are really low. And that proves a really big challenge for investors, particularly as you enter or near retirement and want to preserve your wealth. Because while the G fund is very, very safe, that doesn't mean it is without risk. And what do we mean by that? On a nominal basis, yes, your G fund is not going to lose money. But while nominal matters, while the actual dollar value matters, what matters more is the real value of those assets. And what I'm talking about here, and what we're talking about here is inflation. So even on TSP's own website, they mentioned that the G fund is subject to the possibility that your investment will not grow and keep up with inflation. And why does this matter? Well, if you're in retirement and you're planning to use your assets and use your wealth to, alongside your pension and Social Security, supplement your income and maybe replace most or if not all of your income from when you were working, you want that purchasing power to be preserved. You want the money that you have to be able to buy the same goods that was able to buy when you were working. And that's why we talk about the difference between nominal and real returns. So the nominal returns are what your account did. So if your account was up, let's say 1%, the real returns is that 1% less the effect of inflation or the inflation portion subtracted out. And so what's really important right now, especially, is that because of all the measures that have been taken around the world in response to the coronavirus, because of all the spending in particular, there's been an uptick in inflation. In July, the inflation print was 5.4%. It was over 5% in June and 5% in May. So there's real concerns now about the prices of goods and services overall within the American economy going up. I'm sure many of you have noticed that a trip to the grocery store seems to cost a lot more than it did even a year ago. Same thing with a trip to the pump to get gas. This is the effect of inflation. It's a general rise in the price of goods and services within the economy. We actually covered this in detail in a past webinar as well. And the challenge for G fund investors and for investors within the TSP is that while you may want to be invested safely, the G fund has had trouble keeping up with inflation lately. Over the past decade or so, but since 2010, there have been 10 years where the real G fund returns, or real G fund yields, have been below 2%. So after adjusting for inflation, there have been 9 years where those yields have been below 1%. So you're actually getting a less than 1% real return on your funds. There's actually been 3 years, including last year, where real returns within the thrift G fund were negative. So what does that mean? That means that the interest rate that you were getting within the G fund was less than the experienced inflation rate, less than the CPI. That means that your investment was in real dollars losing money. And this especially matters when we talk about the 4% rule. So some of you may have heard this, or I know we've talked about it before on past webinars, but the 4% rule is this idea of how much you should dedicate or how much you should plan to pull out of your investment accounts every year to supplement your pension or Social Security in retirement. It's a good rule of thumb to help when it comes to the planning process, because the idea is that when you're taking out about 4% of your assets, hopefully your assets are still getting some growth, even if they're invested conservatively. So that way, while you're taking those withdrawals, your funds are growing and replacing some of that loss with growth. So you can sustainably distribute funds out of your retirement account during the course of your retirement. So what we've shown here is an example of $300,000 using a different rates of growth, assuming no withdrawals, how much that account would grow to over a 10, 20, and 30 and 40-year period. So you can see that blue line there at the bottom, doesn't grow very much, right? That $300,000 doesn't really grow very much over the long run at 1% growth. Whereas this light blue line here at the top, if a 6% annual growth rate, it can grow to a heck of a lot if there's no withdrawals coming out of that account. With a $300,000 initial balance can grow to over $3 million over a 40-year period. And then the rest of the numbers fall somewhere in between. Now, this is assuming no withdrawals. However, if instead we assumed a $12,000 annual withdrawal rate, which for those of you who are math minded, you take that $12,000 and you divide that by 300, it comes to 4%. So speaking back to that 4% rule, you see this splay of returns. So because you're taking that withdrawal, the whole calculus changes. If you're only making 1% on your money, your account gets exhausted before 30 years. With 2% growth, the account's almost exhausted, or is exhausted just after 30 years. With 3% growth, you can see how this changes. How, because you're taking that regular withdrawal out, because you're effectively selling a portion of your balance, the growth that you experience within that account matters a heck of a lot. And if we ever, and we've talked about this before on past webinars, when we factor in volatility, so how these amounts might move around more, might gyrate more, that volatility can have an even bigger compounding effect. This is why it's really important to consider where your funds are invested and what the purpose is, or what the goal is for that money before you set it aside for that different goal. And when we think about the 4% rule in the context of the G fund, what's challenging is that because the G fund is not returning very much, it's not returning nearly as much or nearly enough to keep up with that 4% withdrawal rate. So a lot of clients say, well, if the G fund's not an option for me, well, where should I look, or how should I be thinking? And we always start by saying, well, think about it like this. There's basically this investment triangle, or it's a way to frame the trade-offs of different investments. You can have liquidity, safety, and growth. And we almost always say, well, you can basically choose two, or you can move within this triangle, but you can't have all of them. If there was an investment that was totally safe, totally liquid, and had lots and lots of growth potential, every single person would invest in it. But that investment, to my knowledge, and having had experience on Wall Street and in the investment world and with Parco, I've never seen anything that looks like that. So when we consider the trade-offs, when you think about something that's very liquid and has high growth potential, these are things like stocks. These are things like options. These are things that can go up a lot, that you can easily trade and sell and move your money into and out of, but they're risky. They have potential to go down. They're exposed to volatility. You're exposed to loss. So investments that are very liquid and have high opportunity for growth are also risky. They're not safe. But you might say, okay, well, I really want money liquid and I really want money safe. What are my options there? Well, investments that are really liquid and really safe tend not to have a lot of growth. These are things like a checking account or a savings account or cash that you have. So while it's very safe, if it's in the bank, it might be FDIC insured, and it might be very liquid where you can access it very easily. It's not getting a heck of a lot of interest at the bank. I know I've made this joke before, but when I was younger, my mom used to say, "Oh yeah, John, if you put your money in a bank, you're going to get 5% interest." And I said, "Mom, I know you know how old I am because you were there. Bank accounts have never paid 5% interest for as long as I've been around, for as long as I've had a bank account." So that's the trade-off. I mean, I think right now, the bank that I use, it's yielding something like, I think I actually have to pay a fee to have an account there, or the yield zero. If you're lucky, you might get 1% on something that's very liquid and very, very safe. And then if you're looking for something that's safe and has growth potential, well, then the trade-off there is liquidity. And for there, we think about all kinds of different options that are available for clients, be it real estate, be it fixed index annuities, be it long-term investment securities or long-term bonds that might have a attractive yield and growth, but you're trading off that liquidity. That's the real question is which of these three are your biggest priorities for your given goals? And then the money that you set aside for those different goals, we call it goal-based allocation as our financial planning ethos. Based on where your investment goals fall in that triangle is how we determine what investments to elect and to recommend for our clients. Because when we think about things that are safe, in particular, when it comes to investing for income and regular distributions in retirement, you can use the G fund. Other people look at high interest savings accounts or certificates of deposit, but the challenge there is that they have low yields. You could look at bond laddering strategy or fixed income bond ETFs or mutual funds, and those could offer a higher potential yield, but you might be more exposed to loss. Some mutual funds, they might have a fee. And whereas with a fixed indexed annuity or real estate, you might have that safety that we're looking for, and you might have strong growth potential, but you're trading off some liquidity. And so figuring out where your priorities are and where those fit, obviously requires planning, because there's a lot of different moving parts when it comes to planning for retirement. And that's something that our strategists and the fiduciaries on our team help with every single day, helping our clients think through all these different things. So I hope that tonight's presentation gave you some more information about how, and you feel better prepared to think about the G fund and what this press release and what the news about the G fund's interest payment suspension means for you as a federal employee or retiree. Here's a copy of our works cited from tonight's presentation. I also wanted to announce, I know I alluded to this on our last webinar, but we actually have our webinar portal is now live. So a lot of you have asked, hey, can I view these webinars on my own time? For a long time, the answer to that was no. But today, now the answer is yes. So if you follow that QR code that's on the screen, and it'll be on the next page too, you can actually go to our portal. All you have to do is put in your email address, set up an account there. It's totally free. And you can see a bank of webinars that we've uploaded. And we're uploading more every single day as we go back through our backlog. So if anybody has any questions on how that works, feel free to reach out to us, and we're happy to walk you through that. The QR code in the bottom right-hand corner of this slide also links to our website. And if you want, you can actually just take a picture using your iPhone or your Android, and it'll take you right to that website. So in terms of some future topics that we're going to be talking about, we're going to be doing an encore presentation of tonight's presentation next week. So if you found this valuable, you can tell your friends. It'll also be uploaded onto our website as well, so you can view it there. So some future topics, we'll be talking about dual fed families and best practices for federal spouses. There's some interesting strategies that federal couples can do. We'll be talking about taxes and some basic concepts that feds need to be aware of. It's a topic that's becoming more and more prescient, especially as people are concerned about a future of rising taxes. Then we'll talk about the survivor benefit, whether or not it's a good deal, and when it's definitely a good deal, when it's not, when you should consider it when it comes to retirement. We'll talk about mortgage refinance. It's a service that I just mentioned that we now offer and can help our clients with. So we'll be talking about the times when it's worth considering a refinance. I know that interest rates are very favorable right now. And then as a reminder as well, this Sunday we'll be doing our regular monthly retirement paperwork workshop at 6 o'clock Eastern time. Danny will be hosting that and helping out with that. So as always, it was a pleasure to present to you all. We'll be hanging out here answering any questions that you have. So please feel free to ask them. We'll wait to make sure everybody's questions get answered. And if you need to reach out to us in other ways, feel free to do so at our website, our main line 833-GO-PARCO, or shoot us an email at info@GoParco. We look forward to answering your questions and looking forward to helping out.